In today's video, we're going to compare and contrast two trades, and I'll show you one simple tool which allows you to determine which of the two trades is better for your particular trade scenario. Now, first off, this tool is the MTF Market Pulse, and that's available for all Volatility Box members with their membership. It's a free download included for futures and stock Volatility Box members. I'll leave the URL in the description box below. Now, the whole idea of picking and choosing between two different trades here is to find where you can trade in the direction of the trend if you're a trend follower, or if you prefer to do something like the reversion to the mean type of trades, you're looking for trends that are extended and you're looking for a pullback in that trend. Now, the MTF Market Pulse allows you to identify that when you combine it with the Volatility Box models. And I'll show you that in today's video. We had both Salesforce and Honeywell on our stock Volatility Box live scanner, and we were looking for a short side setup in both. Here's Salesforce and here's Honeywell. Now, the key difference between these two, you should notice, is the trend on their longer time frames. I'll start with the daily time frame first before talking about these labels on the chart. On the daily time frame, take a look at what the Market Pulse label tells us. Our market stage, current market stage, is distribution. That tells us that we should be looking at more bearish activity here inside of Honeywell. We surely are not in this stage of acceleration. Contrast this with Salesforce. Salesforce very much in that market stage of acceleration. And if we look at the trend here still looks quite strong, at least on the daily time frame. We even had a recent 1-2 punch setup suggesting we would see more momentum to the upside here. So right off the bat, on the daily time frame, Honeywell looks like the better short. However, this still required us to do a little bit of work to get there. If you wanted to save yourself some time, that's where the MTF Market Pulse becomes quite handy. If you load in the indicator on your chart, and I'd only load this in when you want to use it, and then remove it off of your charts so your charts remain fast and performant. But here, I've loaded it in. Take a look at how many red and orange labels we have. All of these red and orange labels tell you that the trend here is to the bearish side, and you can start at each of these time frames. I like to, for these longer charts, the 30-minute, the 1 hour, the daily, and the weekly are the time frames I like to focus on. And see if there's any opportunity here to take a pullback or a market pulse momentum sort of trade where you're close to the market pulse looking for a short. Now, inside of Honeywell, if we start with the 30-minute time frame, you really had to look no further. On the 30-minute time frame, notice this red market pulse, a trend that was bearish for many days leading up to today. Now, today with the open, we rallied all the way up into our Volatility Box models. Market stage, distribution. You can see here, for a brief moment, we went into that acceleration market pulse here, which was a fake out, and you can see how we tagged right into previous resistance in a strong bearish trend post the earnings volatility. So today, the Volatility Box models gave you an opportunity to take this trend pullback setup where the trend pullback overlapped really nicely with the aggressive Volatility Box. You contrast this with Salesforce. Salesforce was a type of trade for those of you that are reversion to the mean traders. You like to wait for trends to exhaust, and you're looking to then take that trend exhaustion. That was the best setup I could find here in Salesforce. If I start with that same 5-minute time frame, but now you look at these labels here, we said the 30, the 1 hour, the weekly for quick snapshots, all green and yellow, suggesting we need to now find where out of these time frames the trend is a little bit more exhausted. So same idea. If we start with the 30-minute, now we see that the trend feels like it's exhausting on this chart. We have a lot of these Keltner channel wedges. Then we've seen the edge signal confirmation and our momentum cross into the final close. Ideally here, we want to find where trend is exhausting and then pinpoint into smaller time frames, something like that 5-minute or the 2-minute, to then get better entries. That's where today the 5-minute, exactly at that 12 p.m. mark here, this is right into that final hour, gave you the momentum cross, and take a look at what happens to price after that. The trend exhausts here, and we're able to see at least a little bit of an exhaustion. Now, which was the better trade between Salesforce and Honeywell? To me, it's Honeywell. You got to play in the direction of the trend and see how much more effective that was compared to trying to fade a strong trend, in which here across the board we had strong trends on much larger time frames. Honeywell, you were able to have weaker time frames that you could take advantage of, and that to me is the key difference here between these two markets. Again, for all Volatility Box members, you can download the multiple time frame market pulse indicator for free with your membership. I'll leave a link to this in the description box below. Take care, everyone. Good luck trading, and I'll see you in our next update.